It's The Bottom Line with Jacqueline Sheldon. Maximize your return on investment by reducing your tax bill. Get ready for the best tax talk you've ever had. Presented by Bottom Line Tax Solutions. Hello, Jacqueline.
Hi, Tom. How are you?
I'm doing well. I just realized the level of my headphones is outrageous.
Maybe turn them down.
Wow. Who has been in here? I don't know. Just me, I think. Does that mean I'm getting old?
You just can't hear well?
I just can't hear. Is that what it is? Oh, I heard that well. We just pegged the system. That was horrible. It's okay. How are you, dear?
I am doing great. How about yourself?
I'm fantastic.
You're always fantastic.
Except for the ringing now in my ear from my own voice. Wow. Wow. Now I know all those people at Coolray Field felt.
Yeah. Well,
anyway, sorry. Little brag there. Sorry.
Okay, so what are we talking about today, Tom?
We've got a topic that is very timely. We're not supposed to date a podcast. We're really not dating a podcast because, unfortunately, the things that we have just experienced may very well happen again one day.
That is very true.
We are going to talk about, we're not going to talk about natural disasters. There's not a whole lot to say. We are going to talk about how a natural disaster affects a taxpayer / tax deductions / how a taxpayer is affected in the aftermath of a natural disaster.
Right.
And what we mean by natural disasters, tropical storms, hurricanes. Who thought a Category 1 hurricane could come through 1,000 miles inland?
Yeah.
But they seem to lately.
Yeah, it's been pretty bizarre how the weather's been here the last few weeks.
Natural disasters. But now I have to say this because it's me. And you're going to give me a look here in a second.
Okay, here we go.
We were very, very fortunate here in Jackson County.
We were very fortunate. Some of the storms that have come through were scheduled to
hit us. Go
yeah.
right through Jackson County.
And they actually ended up moving over, and we were not.
They swung a little east.
We were not near as impacted as they originally said we might be.
And our brothers and sisters, unfortunately, in North Carolina, got hit really hard.
Yes, they did.
Not cool.
That they weren't quite as prepared for it, I don't believe, as well.
They shouldn't have been.
Right.
Being where they're at geographically.
Right. Well, the original forecast wasn't putting it over that far.
No. I mean, that storm took a hard right, basically.
It did.
But now I have to get this in. You know what I'm about to say.
I know exactly what you're
about
to say.
And it is true. It is just proof that God loves Jackson County. When you're in Jackson County, you are closer to heaven. I mean, that's what boom, proof.
Okay.
Not that God doesn't love North Carolina. He loves North Carolina, too. I love North Carolina.
I know you do.
I fight the urge to just run across the line and never come back. You know that.
Yep.
If it wasn't for this magnificent studio, I probably would have done that by now.
You probably would have.
Honestly, that's true.
You probably would.
I love North Carolina. All right, back to business. When something like this happens, and our friends in North Carolina, seriously, their whole lives have been just turned upside down. And that can happen anywhere. I know right now south of us is going through the same thing. It happens in Texas, Louisiana. It happens. If you've got water nearby, watch out. Tornadoes can do the same thing.
That's true.
Tornadoes that ripped through Kentucky a few years ago, I mean, just leveled everything. How does that affect April 15th?
Okay, well, let's talk.
Or how can it?
Okay, let's talk a little bit about the situation we are in at the moment.
Yeah, this situation.
Okay. As we sit here, extended personal and C corporation tax returns are actually due next week.
Yeah.
But
extensions.
Yeah, the returns that are on extension.
Right.
However, because of the storms that came through, all of Georgia, all of North Carolina, all of South Carolina, then parts of Florida, parts of Tennessee, and parts of Virginia, all will be able to have an extension of time to file until May 1st of 2025. So if you haven't filed your return, if it's under extension and you are in one of the areas affected, then you have potentially until May 1st of next year to file the 2023 return. Then your 2024 returns, which would be due in March or April of 2025, those also have been extended to May 1st. Estimated tax payments for the fourth quarter have also been extended to May 1st. So it kind of pushed everything off until May 1st for people in those areas. And this often happens when you have a national disaster, a federally declared disaster, that if tax returns are due, they will be pushed off. The IRS will give you some additional time to file those returns.
But now this is The IRS picks a date.
They do pick a date.
This is not dyed in the wool. This happens, you have X amount of days. It could be 7 months if they choose. It could be 9 months. It could be 2 months. They choose it.
Right. There's not a set rhyme or reason for how much time they give you on these things. It just depends, I think, on the number of people affected. Has a lot to do with
Probably they estimate it, I would imagine. Do you have to, as a taxpayer, do you have to prove that, hey, I'm in this? Or is it hopefully strictly by a zip code or something like that?
It's by county. Now, like, as I mentioned, the state of Georgia,
which is basically zip code.
The entire
zip codes.
Right, the entire state of Georgia.
Well, entire state's an entire state.
Right. But for Florida, for Tennessee, and for Virginia, it depends on what county you live in and if your county is included.
Right.
Do keep in mind that you don't have to apply for this additional extension of time. It's automatic. So when your return goes in, the IRS is going to see the county that you live in based on that zip code and know that you had the additional time to file. Or if your tax professional happens to be in that area, the tax professional can actually file something with the IRS saying, my client is not in the disaster area, but I am. And so the tax professional could actually get an extension of time for people who live outside of the disaster area, as long as that tax professional is within the area.
That makes sense. That's cool. And that is technically a just a moving target, lack of a better term.
That's correct.
Because they may give you 7 months, they may give you 4 months.
Right.
Now, once they declare, in this case May 1st, can they walk that back and say, oh, we said May 1st, but now we mean March 1st?
No.
They would not do that.
They would not do that.
They may extend it farther out.
Right. But chances are it won't change. Once they've made that determination, it's pretty much there. Mm-hmm.
And the taxpayer does not have to prove it.
Right. You just have to have that address within.
The address. Okay.
Within that area that's been affected.
I got you. All right. FEMA, Federal Emergency Management Agency. The government.
Yay, FEMA.
They give grants. I'm not real sure what any of that means. I've never got one.
Well, for people that are in these affected areas, FEMA will give grants to help them cover their immediate needs. I know right now there's a lot of buzz talk about how much they're allocating to people in North Carolina.
Yeah, we won't get into
enough,
that, but
But yeah, FEMA does give grants to help people in these affected areas. Those grants are not taxable to the taxpayer. So if you receive a FEMA grant, you do not have to pay income tax on that.
Of any amount?
None.
So anything that FEMA gives you, you're not going to pay taxes on?
That is correct.
Period. Long and short of it.
Yes, sir.
That was a quick topic.
That was a quick topic.
Wow.
But there's a lot of confusion on that, and there's a lot of questions taxpayers have when they receive these funds. Am I going to have to include that in my taxable income? And the answer is no.
The taxpayer technically shouldn't even ask about it.
They shouldn't, but
why bother?
Right. Well, as long as the tax preparer is aware that it's not taxable.
Now, taxpayer as an individual, corporation, it doesn't matter.
It doesn't matter. Any FEMA grants for someone
Period.
in a disaster area are not taxable income.
Is that because technically it's already our tax money?
It should be.
And it's our money to begin with?
It should be, yes.
Sorry, soapbox. Well, if FEMA's involved, then obviously something bad happened.
That is true.
If they, decide to get off the couch, sorry. They do a lot of great work.
They do.
I don't know any FEMA people personally. Maybe after this episode I will.
You may have some calling you up. I will say FEMA's kind of gotten a bad rap in the media here lately, but I have clients that do live in these disaster areas that I've spoken with, and they've spoken highly of how FEMA has handled things. So I guess it just depends on.
Unfortunately, I think with these disasters and when a government agency like FEMA is suddenly involved, unfortunately, that is used for sometimes political gain, political jargon, political angling.
Definitely, and I do believe
positioning.
Right now we're in an election year. We're seeing a lot of that right now.
We're technically weeks away at this point.
Yes, we are.
We're not supposed to date a podcast, but it's happening.
Right.
That's happening. So let's talk worst case scenarios, and I mean worst case scenarios. Your house, it's gone.
And unfortunately, a lot of people have experienced that in the last few weeks.
Or it is so damaged that you got to just take it down to the ground and start over.
Right.
Wind, rain, what the water leaves behind, yuck.
Right. And in Florida, there's been a ton of tornadoes that have come through. So tornadoes have taken out a lot of people's homes as well.
So you have a loss. And I'm always looking for deductions. I think I said I was the Oprah of deductions on a previous episode.
Yes.
You get a deduction. You get a deduction, right?
Yes.
Is there a way to turn that bad situation into possibly a deduction, a gain when it comes to taxes?
Potentially.
Jacqueline, hold that thought. We're going to take a real quick break, and we'll be right back. Are you paying too much in taxes? Who isn't? Taxes are the highest expense small businesses face. Maximize your return on investment. Reduce your tax bill. Tax planning and tax resolution strategies, the art of keeping more money you've worked hard for. Schedule your free tax planning consultation by visiting bottomlinega.com. That's bottomlinega.com. Jacqueline, you still there?
I am.
Sweet.
Now, what happens if you have a casualty loss? Under the current tax law, the only type of casualty loss you can take any deduction for is in a federally declared disaster area. So the things we're talking about today.
Yeah, lately that's easy. Yeah.
Definitely qualify. There is a calculation that has to be done to figure out whether you have a gain or loss. Sometimes you can actually have a gain from a disaster, as crazy as that sounds. To be able to determine that, there's several pieces of information that you have to be able to determine. First of all, what is your basis in the property? So let's say it's your house.
Yeah.
What's your basis in the house?
And that's where you bought it at, basically.
Yeah, basically what you paid for it, plus any capital improvements you may have made while you owned it.
New kitchens, new decks, porches,
right,
bathroom
fences,
remodels,
right, those kind of
hardwood
things.
floors.
It gets added too. Now, if you ever used the home for business and you took any depreciation for home office, that gets subtracted back out, so it can get a little complicated.
Sounds like it.
But you figure out, first of all, what your basis is. Then you have to determine what was the fair market value immediately before the disaster.
Minutes before.
And what is the fair market value immediately after.
With or without damage.
Right. So let's say if the whole house is gone, then the fair market value of the home is probably just the land value at that point.
If it's, if it's got to be taken down back to the,
Exactly. So you have to know the fair market value before and basically what they call salvage value after.
So, salvage value. That makes a lot of sense.
Okay.
So it is after the disaster.
Right. So,
okay.
And then you have to take into account any insurance proceeds that you received, because that's going to make a difference in how much of a loss you could have potentially had, or if you potentially had a gain. And then if you received any funds that were specifically designated to rebuilding that home, then you have to take those things into account as well.
Insurance.
Well, besides insurance, if you have a church that gave you money or something along that line to help you rebuild,
right,
then you have to take those things into account. And then bottom line, those numbers determine whether you have a gain or whether you have a loss. So if your cost to rebuild is less than what you received in insurance, then you could potentially have a loss that would be deductible on Schedule A of your tax return. If for some reason you have a gain, then as long as you use that money to replace the home within 2 years, then you can defer the tax on that gain until you sell it.
So that 2-year thing.
You're back to a 2-year thing. Now, here's where things get really sticky, and that has to do with personal property. Okay, so if you lost your house, chances are you lost your furniture.
It's
you
ruined.
lost everything in your home. Then you have a casualty loss not only of the house, but then you have for your furniture and everything else. And so determining fair market value and basis in everything that you own can be daunting when you're in this type of situation.
Oh, yeah.
A lot of people, they don't know where to start with that. So it's not a bad idea to keep some kind of inventory record of what's in your house as far as your furniture and, like you said, in your case, a die-cast collection, different
video it.
things
Shoot
that you
it
have.
to the cloud.
Pictures, video is great, but also just keeping a log of when you bought it, what did you pay for it? So just your major things, your furniture, your televisions, anything that's major, computers, those kind of things. You want to keep a log of that. And even if you have a business location, you want to do the same thing, because you could have a casualty loss for your business, wipe out your business location and your computers and your desks and things there as well. So keeping a log of that stuff is important. Then that way you've got the information to be able to at least have a starting point in determining what your loss is. And as you said, video is great. Pictures is great. That way you don't forget things. And also, if the IRS should ever question a casualty loss, you've got pictures and video proving that you did own these items.
I've got to ask, house is destroyed, regardless, it's got to be rebuilt. You get a settlement with the insurance company, right? They hand you a check.
Right.
regardless if it's good or bad, that's not the point of this. You say, you know what, I'm not doing this. I'm selling the land. I'm moving somewhere else. I'm moving to Arizona. Very seldom do they have hurricanes in Arizona.
Right.
And you may have a $500,000 check.
Right. And then
Maybe more than that. And you sell the land.
Then you have a
Those are
potential
gains?
taxable gain there.
So you're going to be taxed on that.
Right.
Wow. Okay. I could see that. You've lived somewhere, regardless of the amount of time, and it's just wiped out. Maybe you lost somebody. Maybe you lost a neighbor. I mean, bad is bad.
Right.
You may not want to stay there.
Well, and the whole thing would most likely not be taxable, the whole amount that you receive, because you do have that casualty loss. I lost this much in value.
Yeah. Well, yeah, and
if
you
you
probably
have
have
a gain.
you have a mortgage on the property that you've got to satisfy.
Right.
But you could still easily have a $500,000 in your hand even after paying off a mortgage.
Right, and that's true, but you do have basis in that house. You now have a loss in that house, so some of that is going to be to recoup your basis back in that house. But if the check ends up being more than your basis or fair market value evaluation, then you have a taxable gain on that portion if you don't rebuild
that's my
within
point.
2 years. So it wouldn't all be taxable, but there is a chance that a portion of that could come in as taxable income if you don't replace the property that you received the insurance proceeds for.
Gotcha. I'm with you. All right, before we get out of here, it's amazing the support that victims in these areas are getting from us, common folk like me and you,
Right.
across the nation, not just here in the Southeast.
That's very true.
Sending aid. I know here in Jackson County, there has been at least 3, maybe 4 semi-trucks loaded up with supplies, and off they've went. And that's just at the agriculture center here in town.
Right.
That's just one little piece. There's been a lot of semi-trucks coming out of northeast Georgia and South Georgia and Alabama and wherever.
Right.
All that's because of guys like me, gals like you. We go and we raid the Costco. We do. We don't buy one bottle of water. We buy 4 cases.
Right.
Toiletries, paper towels, whatever it is. It feels good to do. You may spend hundreds of dollars doing it. It's easily you can spend hundreds of dollars to do it. Can you use that as a deduction?
Okay, you can only take a tax deduction for those items if you give them to a charitable organization, a 501c3 organization. So a church or another nonprofit type organization, if you donate to them, then it's tax deductible on your tax return. Same thing is true for cash. If you're giving a cash donation, if you give it to a church or a nonprofit organization, then those things are tax deductible on Schedule A if you itemize deductions.
They need to give you some type of receipt.
Well, if you are purchasing items, you're going to keep your receipt when you went to Costco and bought the water and diapers and paper towels or whatever you happen to be sending.
You give it to somebody.
Right, but you have to know who the organization that you gave it to is a 501c3.
The IRS is going to take your word for that?
Well, normally the organization will give you a tax deduction letter letting you know that they are a 501c3.
Okay.
So, yeah, you'd want to make sure that who you give it to is a nonprofit organization.
I don't want to take anything away from the pop-ups. Our subdivision could do it.
Right.
Someone owns a truck, boom, we're going to load it up.
Right.
And knowing our neighbors, it would be filled up in like 10 minutes.
And it would be.
It would be. But now, and no one should be doing this just because I'm going to get a deduction for it.
Right.
But you know me, the Oprah of deductions. If we can squeeze a couple pennies out, we're going to do it.
Right. Well, in that case, if our subdivision did it, then there would be no tax deduction for it because we did not give it to a 501c3. Now, it depends on what you do on the other end. You know, if you're loading it up here in the subdivision and then you're taking it and delivering it to a church or something
Which is a
along
smart
that
way to
line,
do it so you know it goes the right place.
then you might be able to get a tax deduction because you're actually making that donation to a nonprofit.
Right.
Now, if you go up there and you're handing out water to people who live in the area directly from you to them, then it would not be tax deductible.
Right. Which we thought about doing. We actually did. Myself and some of my Barrow County family.
Right.
We thought about doing it.
And let's talk a little bit further about that because I have a lot of clients who have gone up to lend aid to work to help search and rescue, those kind of things. There again, if you are doing this work for a charitable organization through your church group or through a nonprofit, then you might be able to take a tax deduction for some of your costs of being there.
Lodging up there,
lodging,
mileage.
those kind of things. So if you have out-of-pocket expenses, but there again, it has to be working for a charitable organization.
You say working, volunteering?
Yes, volunteering.
They're not paying you.
Right, you're not getting paid.
Okay.
Yeah, we're talking about
or even I guess if they are paying you, if you're an employee of, are those things still deductible if you're doing your job?
Well, if you have the
like hotel rooms
right,
and stuff
well,
like that.
Yeah, there again, that probably not as far as an unreimbursed employee expense because you can't take it. But
Okay, well that's what I thought. Yeah.
but if it's charitable work, if you're getting paid to do it, then chances are it's not considered charitable work, right? But if you're going up there with your church group, I know a lot of nonprofits have gone up there. If you're going to work there with a charitable organization, then your mileage, potentially meals, potentially hotel stays, you can find a hotel room, and those kind of things could be a charitable deduction. Keep in mind to take charitable deductions, though, you do have to itemize on your tax return. If you don't itemize, then you won't be able to get a deduction for it.
I wish we didn't even have to talk about this.
I do too, because you think about the devastation. There's been loss of life, there's been loss of property, and then even outside of that, people who just can't live their day-to-day lives. They have no power, they have no water, they have no cell phone, they have no internet.
For weeks.
Their lives have been disrupted. And some of the clients that I've talked to that are in the North Carolina area, they're not expecting water to be back for over a month.
Yeah.
I don't think we realize how much we depend on water until you don't have it.
It's the new gold, ladies and gentlemen.
Exactly. So, there's just...
And not just water, but getting it in, but getting it out.
Right.
Yeah. Oh, yeah. Well, Jacqueline, I enjoyed the conversation as always.
It was great to be here. And like you said, it
the Northeast Studio.
Wasn't the best topic to have to talk about, but it's definitely a timely one.
A lot of good information. Folks, I'm Tom. She's Jacqueline, and that's the bottom line. For more information on today's topic, reach out to Jacqueline and her tax professionals at Bottom Line Tax Solutions, 678-866-4048, or visit bottomlinega.com for all your tax planning, tax preparation, and tax problem-solving needs.